all of you. On behalf of Professional Development Committee of Western India Regional Council, I welcome you all for the series on Guide for Efficient Cost Audit. Today is a part 2. It covers annexures D3 and D4. I request CMA Dushyant sir to kindly start the session. Thank you.
Yeah, good afternoon, everyone. We will start with the session today. This is the third webinar we started. Our first topic was audit to advisory, where we told everybody that how we can convert our cost audit information into the consulting practice and advisory practice. That was received well, and I thank you for various compliments which has been received. And a lot of people have asked for the recording of it, but also Institute is going to work on it. So now, thereafter we had the first session on the pro formas. We started with the cost accounting annexures. That was again, we received pretty well. We have gone beyond the pure, vouching of the transactions. We rather went with the more detailed value addition part of the whole cost audit. So that was also has been received quite well. Now in today's session, we will go a step further, go to the D3, D4. It is indeed a pleasure to interact with such a distinguished gathering of cost and management accountants from different industries, different sectors, and different parts of the country. This webinar forms the second part of our series titled Guide for Efficient Cost Audit. We have already defined what is efficient and what is audit in the previous sessions. We discussed the earlier parts of the cost audit report. Now we move to the two annexes, which are often considered simple because they appear at the end of the report. However, in practice, these are among the most scrutinized sections during the regulatory review. Many practicing cost accountants prepare these schedules mechanically by copying figures from the financial statements without understanding the logic behind each item. That is exactly what we intend to address today. Today's objective is not merely to explain what should be filled in the annexures. Our objective is to understand why each figure is reported in D3 or D4, where the information originates, which source document should be relied upon, how each amount should be audited, which item should be included, which should be excluded, what practical challenges are commonly faced, and how to resolve these challenges in a professional manner. Throughout the webinar, I encourage you, everyone, to think like an auditor rather than merely a form filler. Remember, the cost audit report is not a compliance document alone, it's a professional certification. Every figure we certify should be supported by proper evidence and audit documentation. I will also be sharing practical experiences from my 30 years of practice in the cost audit, carried out across different industries, across the sizes, so that the discussion remains application oriented rather than the theoretical. Please feel free to note down your queries. We will address all the queries at the end of the session. I've intentionally included discussion points throughout the session, and we will also have a dedicated interaction towards the end. By the time those who have been attending for the last 3 sessions, they know that this webinar has been interactive webinar. I involve people at different stages of the discussion, and that's what. Now let us now begin. So I encourage everyone to please chip in through the chat more during the webinar as well. So now let us begin by understanding today's roadmap. Before we discuss D3, it is important that everyone understand how today's session has been structured. So, today's roadmap, as you can see on the screen, before we enter into the technical aspects, let me briefly explain how today's learning journey has been designed. Many webinars simply explain the format of the cost audit report. However, my objective today is slightly different. I would like every participant to leave today's webinar with sufficient confidence to independently prepare an extra D3 and an extra D4 for any cost audit assignment, and then interact with the management on this D3, D4. Whether you are conducting a cost audit for a cement company or a steel plant or a chemical unit or a pharma company or an engineering or any other manufacturing entity, the principles remain exactly the same. So our annexures are industry sector agnostic. Therefore, today's discussion is principle based rather than the industry specific. Our session now has been divided into 4 logical steps. Stage 1, first we shall understand the philosophy behind Annex D3. Whenever the institute introduces a reporting requirement, it is intended to convey meaningful information, not merely numbers. Unless we understand the purpose behind the reporting requirement, mistakes become inevitable. Therefore, before discussing any line item, we shall understand why the MCA requires this statement in the first place. Stage 2, we will examine every line item now. Once understanding the meaning of D3, we go into the line item of D3. And instead of simply reading the format, we shall answer 4 questions to every line item. Where does this figure come from? Which ledger supports this figure? Which financial statement supports it? How should the cost auditor verify it? And this approach will make your working papers much stronger. Stage 3, then we'll go to discuss a dummy statement. Of course, dummy is dummy in the word, but then we have taken it from our actual audit clients' numbers and we have mixed and presented to you. This is perhaps the most important part of today's session, because once you understand one complete illustration, every future cost audit becomes much easier. While discussing the practical illustrations, I shall also explain several practical mistakes observed during the cost audits. And finally, we shall move to Annex D4. Many professionals simply calculate ratios. However, ratio analysis is not arithmetic. Ratio analysis tells the financial story of the company. A cost auditor should be able to interpret every ratio. Suppose the debt equity ratio has increased, then was it good, bad, in what context it increased, was there a capex, and so on and so forth. These are the analytical skills expected from the practicing cost accountant. Throughout today's discussion, please do not focus only on completing the reporting format. Focus on understanding the business. If the business is understood correctly, the reporting automatically becomes accurate. Now, at this stage, let me ask all our participants a simple question. What is the biggest mistake made while preparing an extra D3? Can anybody write on the chat what is the biggest mistake we are making while preparing an extra D3? Anybody would like to put it on the chat? What is the biggest mistake we are making while preparing a D3? D3, to give a name, it's a value addition and distribution of earnings. Anybody would like to talk about what are the common mistakes which we do while preparing a D3? Friends, this is going to be an interactive webinar to make sure that everybody is awake after the post-lunch session and everybody is just not attending by just marking the attendance. Anybody would like to answer this? What are the major mistakes will be done at the time of D3? Okay. In my experience, the biggest mistake is not arithmetic. The biggest mistake is incorrect classification. People include items which should never form part of the value addition. I'll explain you in the subsequent slides how. A second question. Why do you think the government wants value addition instead of merely profit? Why we couldn't be why we are not confined only to the government has said just you have given a B2, you have given a profit, it should be fine. Why the government wants value addition instead of merely profit? Can anybody answer this question? Why this D3 exists, first of all? My friends, it's very important that as a practicing cost accountant, we know the meaning and the value of each and every statement which we are certifying. Then and then only we are able to provide, give a project, a right image of a practicing cost accountant to our clients. A client probably can ask you this question, that why you are preparing D3 at all? What is the reason for D3? Can anybody write on a chart that why the value addition statement is required by the government? Should I wait for the chat answer to come, or should I carry on? Anybody would like to raise a hand or write something? The only thing I am reading is the membership number. No idea. All right, that's a very, very honest answer. I love it. So because now let me answer you the question. Why value addition is asked by the government and not merely profit? Because the profit belongs to shareholders. Okay, value addition belongs to the society as a whole. It belongs to all the stakeholders of a company. It reflects the economic contribution created by manufacturing activity. This is why D3 has tremendous importance from a policy perspective. Please remember this and explain this to your clients always, that it's why value addition statement, because it's a value addition for all the stakeholders of the company. Now that we understand the roadmap, let us understand the two annexures at a conceptual level. So before studying each annexure separately, let us first understand the difference between them. What is the difference between part 3 and part D4? So annexure D3 or a part D3 is essentially an economic statement. It is an economic statement, whereas D4 is essentially a financial statement. Please digest it properly. D3 is an economic statement which talks about value addition. D4 is essentially a financial statement. These two schedules complement each other. One measures the value creation, the other measures the financial efficiency. Suppose two companies on the same profit. Does it mean both the companies are equally efficient? Not necessarily. One company may have generated much higher value addition. Another company may have generated the same profit using twice the capital employed. This is why both statements are required. Together, they tell the complete performance story. There are slides kept on the screen. Do you want us to read it, or you can all read it properly very well? So slide part D3 tells you the value addition and distribution. It describes, and it also describes why it matters, because it helps the auditor and stakeholders to see the economic contribution of the product service and whether earnings are distributed in a sustainable and balanced way, which is very, very important, the resource utilization. Let me give you one more practical example. Suppose company A and company both report a profit before taxes 100 crores. However, company A has capital employed of 500 crores. Company B has capital employed of 1000 crores. Immediately we realize that company A is using capital much more efficiently. That insight comes only through annexure D4. This is what we are going to look into. Let us now begin our detailed discussion with part D3. This is perhaps the most important conceptual slide in today's webinar, part D3. As you can see on the slide, that's a headline, value addition and distribution of earnings, how value is created through operations and how it is shared among employees, government, capital providers, and reinvestment. If you understand this slide thoroughly, the remaining part of annexure D3 becomes extremely logical. Let us first understand the meaning of value addition. Many people confuse sales with value addition. Now, sales represent the value of goods sold. It's not a value addition. Value addition represents the additional wealth created by the enterprise after converting purchased inputs into the finished products. More simply, the value which is added on the raw material to turn into the finished product is a value addition, which is an additional wealth created. In simple words, suppose the company purchases raw materials worth 100. After processing, manufacturing, quality control, packaging, and marketing, it sells the finished products at 180. So has the company created 180 as a value? No. The company has created rupees 80 as additional value. So that additional value is known as a value addition. This value is generated. How it is generated? Because there was a plant, there are people who worked on it. So we have employees, we have technology, we have manufacturing expertise. The management worked on this, setting up this plant and managed it. There's a production system to work, there are QC, there is research, and there is a supply chain efficiency. I mean to say the logistics and freight part of it. Therefore, Annex D3 is not merely a financial schedule. It exactly says that how all these factors work together, right, from employees to the supply chain efficiency to create this particular additional value. It measures the economic contribution made by the manufacturing enterprise. Now let us move to the second aspect. Once value has been created, who receives that value? Does the entire amount belong to shareholders? Certainly not. The value is distributed among several stakeholders. The names which I gave earlier. Employees receive their salaries, wages, and benefits. Government receives their taxes and duties. So government is a stakeholder. Banks and investors receive returns on their loans and equity dividends. Company retains a profit for a future growth, which gets transferred to reserves and surplus, not distributed to shareholders. Thus, Annexure D3 tells us whether the wealth created by the organization is being distributed in a balanced and sustained manner. You can easily make out the importance of each and every stakeholder by looking at the distribution of the value. From an audit perspective, there is another very important point. One of the strongest built-in audit checks in the cost audit report is that total value addition must equal total distribution of earnings. I am repeating. The strongest built-in audit checks in the cost audit report is the total value addition must become equal to total distribution of earnings. If these two figures do not match, it indicates one of the three possibilities. Classification error, omission of an item altogether, and incorrect computation. But anyway, it gives you the red flag that something is wrong in the entire statement. This equality is therefore one of the first sanity checks every cost auditor should perform before signing the report. Finally, I would like to emphasize that D3 is not just useful for regulators. It is also a powerful management tool. So as in my all earlier webinars, I have kept on, harping on the management use of our cost audit annexes. In all our groups, we keep on discussing the management apathy towards the cost audit. How it is some management treated only simply as a compliance tool and not as a management accounting tool. But if we as a cost accountant are able to find a meaning to our own statements, then that is something which you have to translate to your client. So trends in value addition, for example, can reveal changes in the operational efficiency, labor productivity, taxation impact, and reinvestment strategy over time. So the value addition gives you answers to everything what the company does. Now let me rope you guys in. I've been talking alone for a long time. My question, if the company reports a loss, should Annexure D3 still be prepared? Because D3, I went on talking, it talks about value addition, distribution of earnings. What if the earnings are not there? Should we still prepare D3? Can somebody say yes or no? Straight answer. Should somebody prepare a D3 if there are no earnings? Can somebody chip in? Yeah. All right. Yes, Sanath, thank you. Anybody else would like to answer? No. Mr. Ramlakhan has said no. If there are no earnings, don't prepare D3. Then, anybody else would like to talk? We received both the answers, yes or no. No. Anybody else too? Yes. Okay. Anyone else? Okay, I don't find many interactions happening, but I hope that all of you are actively listening to this. This is a webinar on D3, which actually never happens in our so many webinars. We keep on talking about AI and SAP and everything, but people don't talk about the individual annexures. Let me tell you, if the company reports a loss, should annexure D3 still be prepared? Yes. Annexure D3 has to be prepared irrespective of whether there is a profit or a loss. Because Annexure D3 is based on value creation and distribution, not merely on accounting profit. Even a loss-making company may have created value and distributed it among employees, government, and lenders. So remember, the moment you have a raw material and add any value to it to make it a finished product, yes, you might have not made as much money, or you might have made a loss because the market competitive forces have reduced your price and you couldn't cover your cost. But the fact remains that you have a factory, you consume the utility, you have the employees to whom you paid the salary, you paid the GST. So all the stakeholders did receive the money out of your manufacturing activity. So there is a value addition and you did distribute. If there was no such distribution required to any one of them, then probably you would have made a profit. But yes, I think even that loss goes to the extent of that the company itself goes into bearing that particular loss. So it's for that company could be a little, for the company itself is a negative value creation. But there is a value addition and there is a distribution of earnings. My second question. I hope people are now tuned to it and ready to be part of this, because we are all we are all in the practice where we attend to this D3 very regularly. Why must total value addition equal total distribution? Okay, if anybody would like to answer in a short couple of sentences, why must total value addition should equal, I made a statement that cost auditor must do this sanity check or a tally that all value addition should be equal to the distribution of the earnings. Why? What is the reason for that? But anybody would like to attempt this? That why value addition should equal total distribution? Okay. Too much thinking. Now, the reason is because the value generated by operations and ultimately be allocated to stakeholders. Yes, Mr. Sanath, you're right, because that's the source for the distribution. Yeah, then I'll wait for a minute to have more answers. That was a good answer as well. Yes, that's why it should be the same. Correct. Anyone else? So as our colleague said, it's very right. The value generated by operations must ultimately be allocated to stakeholders or retained within the business. So this equality acts as internal reconciliation, an important audit valuation check. Now that now we went through the entire philosophy behind Annexure D3, right? And as I said in the beginning, our flaw is that we'll understand the Annexure D3 and then we'll get into the more details about the D3. So let us examine now why this statement occupies such an important place in the cost audit report. Why D3 they have put in. Now, whatever I'm saying, you can please repeat this. Go back to your client and repeat, if you didn't know and I have told you something new about D3. One common misconception is that D3 is merely a summary statement prepared after completing the cost audit. In reality, it is much more than that. It's a validation statement. Every figure in D3 is derived from information that has already been audited through cost audit records, financial statements, production records, inventory records, and statutory returns. Therefore, when we prepare D3, we are not creating new information. We are consolidating audited information into a meaningful picture of value creation. The P figures, as I said earlier, all figures have been audited, checked. Now we are creating a value creation out of that particular data. Think of the statement as the economic story of the enterprise. Financial statement tell us whether the company earned a profit. Cost records tell us the cost of manufacturing. But D3 answers a different question. How much wealth has the enterprise actually created for society through its manufacturing operation? This is different from how much profit company generated. A financial auditor would only talk about the profit generated. It is amazing that our D3 talks about the wealth generated by the enterprise for the society. This is why regulators, management, lenders, and policymakers must find this statement valuable. You can, whether you're an auditor of a company or not, you can pick up any balance sheet of any company and create a value D3 statement out of it, though you may not be the auditor, but it will give you this information that how the value creation is happening each and every company. Suppose a manufacturing company purchases raw material. Let us understand. Let me give you one more example. Suppose he purchases raw materials with 100 lakhs. It converts those materials into finished product and sells them. So 180 lakhs. This additional 80 lakhs is not merely profit. It is a result of labor, technology, management, production efficiency, and manufacturing expertise. This additional wealth is what D3 seeks to measure. This is how now I'm sure that everybody has fully understood the D3 and the value creation. Now, why should a cost auditor pay special attention to this? Cost auditor can simply look at the annexure, sign it, it's all fine, and go ahead. No, as cost auditors, we certify not only the arithmetic accuracy but also the integrity of the classifications. A small classification error, for example, including non-operating income or excluding certain operating costs, can distort the entire value addition competition. This is what my first question was, that what are generally the errors which we make? We make the errors of classification. This is the one example of that. Therefore, while auditing the statement, ask yourself these questions. Does every figure relate to operating activities? Is the source document reliable? Has the same accounting policy been followed consistently? Are there any exceptional or one-time items that need separate disclosure? And can every figure be traced back to a ledger, cost record, or a financial statement? So tracing a figure to a particular source document is a fundamental to any audit exercise, as you all know. Never prepare D3 at the end of the audit. My practical audit tip, if I would like to give you here, is that never prepare D3 at the end of the audit as a routine exercise. Instead, prepare a draft early in the audit. Doing so often highlights inconsistencies that may otherwise remain unnoticed until the final stage. Let me ask you another question to keep you all guys glued to this a little more actively. Why is a D3 called a validation statement? The D3 is called a validation statement because it consolidates figures already verified during the cost audit. So if D3 does not reconcile properly, it often indicates an issue in the underlying records of classification. Second question, is D3 prepared for statutory compliance only? Obviously, with all the discussion which we had till now, D3 is just not only for compliance, it forms part of the statutory cost audit records, of course, but it also equally is useful for management analysis, benchmarking, and understanding the economic contribution of the enterprise. While management analysis you'll understand, but how the benchmarking? See, all these entire data you can compare with your peer comparison. You can take out the data from your industry, which are a listed company environment, or you can even take out the data from the MCA and compare the value addition statements of one company with another. So you can do the benchmarking and understanding the economic contribution of the enterprise. So now that we understand the purpose of D3, let us examine how each line item is computed, and more importantly, where the cost auditor should obtain the required information. See, now we are getting into the practicality. I hope that people have understood the importance of it, why it is such an important statement, what is its usefulness to the management, government, Now we are coming to the very mundane part of the whole thing, but which is very important, that how do we look at the actual part D3 annexure to the cost audit report, which has been prescribed by the MCAs in the CRA3. Let us now go one by one item. You can see on the screen the exact annexure, the way in which we prepare all our cost accounting records for each and every client. I'll start with the revenue from operations. This is the first line item. Revenue from operations, where will you extract it from? Anybody would like to guess? Where will you pick up the revenue from operations? Let's prepare it together, this statement, all of us, if you don't mind. Where will you pick up revenue from operations? Can somebody just write one line? Where will you pick up revenue? A4, okay. A4 is the one statement which you prepared in the cost audit only from P&L, correct? So you should not take the statement from your own statement, because then the errors which you would have done in A4 will creep in here as well. So you should have an independent source of record. So the one which I have put it already in the side, actually I have already leaked the answer paper here. You can see it on the screen itself. So revenue comes from sales register or revenue from operations in the P&L account. Then less taxes and other dues. Where will you take it from? Of course, taxes and other dues, which will be appearing in the original ledger. And that's how you arrive at a net revenue. And net revenue, again, it's a arithmetic. So 1 minus 2 is equal to 3. And then you add the export incentives, which is again included in the revenue from operation or other operating income. Anything anybody doesn't understand, please write on the chat, okay? If somebody is a very fresh CMA who is looking at these numbers and getting bewildered at why I'm talking so fast and each and every line item, please write in the chat, either go slow or tell me that which line item you want to understand, because this is fundamental to, before I speak about the greatness of the value addition, you should actually prepare a good, correct value addition statement before you come back to understanding this. So then, of course, you do the adjustment for finished goods and WIP. Changes in inventory you will be accounting for. And then process material consumed. We have raw material consumption, ledger will give you that. Consumption of stores and spares, you will find it from the notes to the accounts or even in the general ledger. Utilities again. So all this statement is you have already done when you are preparing B2, etc. The data was available and now you are putting in totality. This is available from the general ledger. And then you come with a grand figure, item number 7, value added. Value added of this year as well as compared to the previous year. And then to have a value added, you add income from any other sources. And you like if which was not part of the normal operations. If suppose if you have done an investment income, etc. Because this has to finally tally with the earnings, which is very important. Value addition is very important, but then from the management point of view, but finally it should tally with your financial P&L account. So on the value added, you will add whatever was an exceptional thing. Somebody asked which thing gets covered in the process material. Your B2 should be able to give you what are the process materials you have used, and you can also pick it up from the ledger. Employees and salaries. Now, how did you distribute this value addition earnings, which is available for distribution? As I said, that your value added should equal to the distribution. So you have distributed earning to employees, shareholders as dividend, company as retained funds, government as taxes, then extraordinary expenses, if any, others again, which is not part of the cost of production or the normal business operations, and that would be equal to total distribution of earnings. So this is your part D3. Now, I am again repeating in a summary format the whole D3 which we discussed just now. While computing value addition, what do you include and exclude, which I mentioned earlier in my talk, that we will also talk about what to exclude from the revenue. Now, including is, of course, sales, excluding is interest income, dividend, profit on sale, which is there on the screen right now. Similarly, in the export incentives, also there are certain inclusion and exclusions. Please go through this thoroughly, which is reproduced in the slide. Now, while talking about various items on the, let me talk something on the taxes and duties. GST, as you know, is a tax collected on behalf of the government. It does not represent value created by the enterprise. Therefore, GST and indirect taxes should be deducted to arrive at a net revenue from operations. Verify the figures with GST returns and reconcile them. Then the export incentives, again, the incentives such as duty drawback, etc., are included because they are directly linked to the manufacturing and export incentives. Our distinguish between operating incentive and capital subsidies. Capital subsidies generally do not form part of the opening value addition. Then, of course, inventory changes can significantly influence value addition. Verify inventory valuation methods, ensure consistency with accounting standards, and reconcile opening and closing stock with the cost records. A change in valuation policy should be disclosed and understood. Then there are cost of bought out inputs. For example, though you are making a product, you might be doing a trading by buying a finished product and selling it. So this includes raw material, process material, stores, space, utilities, and other externally procured inputs. The objective is to identify the value contributed by the enterprise itself, excluding the value already embedded in the purchase inputs. On audit procedures, for each line item, trace the amount to the general ledger. Please verify supporting schedule, reconcile with cost records, check consistency with the previous years, and investigate if there is any unusual variances. Now, let me give you a practical example. Suppose power consumption is increased by 25%, while production is increased by only 5%. This discrepancy warrants further investigation. It may indicate inefficiencies, incorrect allocation, or data errors. Should scrap sales be included in the revenue from operations? Answer is that it depends on the nature of business and accounting policy. If scrap generation is an integral part of manufacturing operation and recognized as an operating revenue, it may be included. Otherwise, you basically evaluate its materiality and nature carefully. Inventory adjustment, as I already discussed that. Now having underscored the sources of the first set of figures, let us now move to the second half of the statement dealing with the distribution of earnings. Once value addition has been computed, the next question is how has this value been distributed? So answer lies in the second part of Annex 33. The distribution reflects how the wealth created by enterprise is shared. Employees, shareholders, companies retained fund, government, exceptional ordinary items. Now in employees, every cost which has been incurred on the employees, salaries, wages, bonus, gratuity, provident fund, all retirement benefits, reconcile these figures with the employee benefit not in the financial accounts. The shareholders, the dividend declared represents the return distributed to shareholders. Verify the figure with a statement of changes in equity or the relevant note to the financial statements. Company has retained funds. Retained earnings represent the portion of the value retained for the future growth. We will discuss the retained computation in the next slide. But remember that the retained earnings are not simply the closing balance of reserves. They require proper adjustment. We'll discuss that soon. And the government taxes paid by the enterprise represent another important distribution of value. Ensure that only taxes borne by the company are included, not taxes merely collected on behalf of the government. This is a very important difference. Now, exceptional and extraordinary items, these should be disclosed separately to preserve the analytical usefulness of the statements. One-time events should not distort operational performance. This is very important. The sum of all distribution items must equal the earnings available for distribution. I'm repeating this third time, but this is very important. This reconciliation is a key audit check. In practice, what happens is one of the most frequent errors is the omission of certain employee-related benefits, such as leave encashment or a gratuity expenses, which might be happening one time and may not have been included in the salaries and wages. Ensure that all employee benefit costs recognized in the financial statements are appropriately considered. Now, let's make it a little more interactive. I spoke for a very long time. Should proposed dividend be included? Can somebody answer yes or no? Somebody answer this question? Should proposed dividends be included? Rajiv says no. Avni says no. Prafulata no. Yeah. Anybody else? Arun Agarwal says yes. Okay. I'm getting more no answer. Yeah. So the answer is that you include dividends in accordance with the applicable financial reporting framework and the reporting requirements for the period under audit. Because finally, you always verify the basis which is adopted. My second question, should deferred tax be included in the government taxes? Should deferred tax be included under government taxes? No. Somebody says yes, should deferred tax be included under government taxes? Again here, generally focus on taxes recognized in accordance with the reporting requirement of the cost audit report. Review the guidance applicable to the reporting period and maintain consistency. That's the most important part of the whole thing. Okay, in both the cases. Now, before we move to the complete illustrative statement, there is one important area that deserves special attention: the inclusion and exclusion rules. I put it on the screen, what is included and what is excluded. Again, what do you exclude in the revenue? Interest income, dividend, profit. See, because these are the types of income which has nothing to do with the business enterprise. This happened out of the investments. Similarly, in the export incentives, you exclude interest subsidy, capital subsidy, PLI incentive, because these are subsidies and grants in nature. Again, this has nothing to do with the business enterprise. Subsidies can go away next year. It may not sustain. It might have been given for 5 years or 7 years or 10 years duration. This is more of a government assistance to a company to set up a unit in a backward area. But this is definitely not part of the business enterprise. But this slide is very important from practical audit perspective, because many reporting errors arise not from incorrect calculations, but from incorrect classification, as I'm again repeating. The guiding principle is straightforward: include only items that arise from normal operating activities of the enterprise and contribute to value creation. For example, sales, export incentives, job work income are generally included because they arise directly from manufacturing or operating activities. On the other hand, interest income, dividend, profit, as I said, should be excluded. Same with the export incentives. So before now we finalize with D3, we have taken nearly almost half of it for the D3. Before finalizing, let us verify some of the things. What we have to verify? We have to verify whether all the non-operating incomes have been excluded. We have to verify whether have operating incentives been appropriately identified. Has the treatment remained consistent with the previous years? And if not, then you have to mention in the accounting policy, change in accounting policy. Are exceptional items separately disclosed? And has management provided adequate explanation for unusual items? This is very important. Common mistakes again here. You include the bank interest in the value addition. You including profit on sale of machinery. Treating capital subsidies as operating income. omitting export incentives, which are directly linked to manufacturing. They should be actually included because they are directly linked to the manufacturing activities. These mistakes can materially affect the usefulness of Annex D3 and should be avoided. Now, again, make it a little more interactive. Why is interest income excluded even though it increases profit? Because value addition measures wealth generated through manufacturing and operating activities, not returns from financial investment. So suppose I have a surplus in fund lying in my account and I put it in mutual fund, gilt fund, liquid fund, and I'm getting an income out of it. This is not part of the value addition of the business enterprise. It didn't come out of the production activity. Similarly, if rental income is earned from factory premises, should it be included? Evaluate whether the rental activity forms part of the company's ordering. So the person who is into real estate renting business, for him, it's a part of the business. Whereas the person who is into manufacturing chemicals, he has just given his surplus premises for the rental and it is actually not part of the value addition business which you are talking about. If it is incidental or non-operating, it should generally be excluded. So with the principles of computation now clear, we are ready to examine two critical practical areas. We are still on D3. The computation of retained funds is one thing, the treatment of others, and finally a complete illustrative Annex D3. These topics will form the next part of our discussion. Ladies and gentlemen, one of the most frequently misunderstood figures in Annex D3 is the company as retained funds. You have seen the company retained funds in the annexure. Many cost auditors simply look at the balance under the reserves and surplus and report that figure. That's incorrect. Retained fund does not represent accumulated reserves. It represents a portion of current year's value addition that remains available within the company after distribution to external shareholders. So this is an important conceptual discussion. Imagine a family earns 10 lakhs a year. They spend 6 lakhs on household expenses. 1 lakh is paid as tax, 50,000 is donated. The remaining amount stays with the family. That balance becomes savings. Similarly, a company generates value. Part of that value goes to employees, part goes to the government, part goes to shareholders. The remaining amount stays inside the company. That is called retained fund. Now, why we are adding depreciation back? This is the one question that almost every cost-oriented person who is joined, not the trainee, but intern or maybe a cost accountant himself, the depreciation reduces accounting profit. But does it reduce cash? No, because it's a book entry. No money leaves the business. Depreciation is only an accounting allocation of asset cost. Why you provide a depreciation? Just to tell you the basics. When you buy a machinery, you keep on providing depreciation provision, make a provision over whatever percentage you would like to have and keep a provision of it so that when the asset completes its life after 10 years, you have fund available to buy another machinery. That's the commercial principle of having a depreciation account. Okay. But practically, it doesn't leave the cash. You only created a provision. It's only an accounting allocation of the asset cost. Therefore, from the perspective of value retained within the enterprise, depreciation represents an internal source of funds. Consequently, it is added back while determining the retained funds. I'll give you a couple of practical illustrations. Let's say, for example, in a company, there is a profit after tax of 120 crores. Depreciation is 40 crores. Say, let us say dividend is 30 crores. Then the retained fund will be 120 plus 40 depreciation added back minus 30 dividend deducted, 130 crore. Notice something interesting here. The company retained more funds than its accounting profit. Why? Because depreciation did not involve the cash outflow. Whenever you verify retained fund, I recommend following this sequence. Obtained audited financial statements, locate total comprehensive income, verify depreciation schedule, verify dividend declaration, recompute independently. never rely solely on the management competition. This is how we do in our own practice. And I can repeat it again. For verifying retained fund, step 1 is obtain the audited financial statements, locate the total comprehensive income in that financial statements, verify the depreciation schedule which is appearing in those financial statements, verify dividend declaration which is in the annual report, recompute it independently. Common practical mistakes here again. Over the years, I've observed several recurring errors. Some cost editors use closing reserves instead of retained earnings. Forget depreciation adjustment. Deduct proposed dividend instead of declared dividend. Ignore OCI adjustments. Use standalone in 1 year and consolidate it in another. So, the companies have consolidated results and the standalone results. The companies which have subsidiaries and all. So you have to use only one of that. And all of these result in inconsistency. Always prepare an independent working paper showing the computation, even if management provides a figure. Your audit file should demonstrate how you verified it. It should become part of your audit papers. Now, of course, I have a very simple question. I would like to make it just to make it a little more interactive and people take participation. Why do we add depreciation back? Any answer? Quickly. Why do we add this depreciation back? What is the reason for adding depreciation back? To my active members who have been answering almost every question, can you please answer? Non-cash expense. Avni, yes. Anybody else? Non-cash item, yes. It's a non-cash. It's a non-cash item. Wonderful. So because depreciation is a non-cash, it's declared. So it reduces accounting profit, but not the resources retained within the business. You are not parted with the cash, but you have you've shown it as an expenditure so that you have provided. That's why we call it depreciation provision, not depreciation paid. You don't pay a depreciation. You provide for the depreciation as much as you provide for the bad debts. Now that we have understood retained funds fully, let us discuss another area where professionals often have doubts: the treatment of others in the distribution of earnings. I have put on the slide on the screen, as you can see, what to include in while computing valuation and others as well. So others expenses from notes to accounts excludes consumption of stores and spares, utilities and non-cost items. And you are adding purchase of stock in trade. Now, one of the most difficult areas in D3 is a category called others. Whenever accountants encounter a miscellaneous column, there is a tendency to treat it as a dumping ground. As cost auditors, we should never permit that approach. Every item should included under others should satisfy 3 tests. Is it relevant? Is it appropriately classified? And can it be supported by documentary evidence? Let's discuss an example. 3 checks, 3 tests for about others. Is it relevant? Is it appropriately classified? And can it be supported by documentary evidence? Let me give you an example. CSR expenditure. Okay. This CSR expenditure represents value distributed back to society. It is very much value, distribution of earnings. So accordingly, it is generally reported under others. Why it is others? Because it is not part of any cost. It doesn't come under depreciation, doesn't come under utilities. It's a CSR cost. So CSR cost is shown under others. So what am I supposed to do? Go into the others, take the listing of what is included in others from the general ledger, verify the CSR schedules, board report disclosures, and expenditure ledgers. Okay. Similarly, finance cost. Finance cost represents compensation paid to providers of borrowed capital. Therefore, its treatment should be consistent with the reporting requirements. Bad debts, which I gave an example, it represents economic loss. So verify customer ledger, aging analysis. When you put anything in bad debts, it requires a board approval and the provision policy. Donations. Some donations qualify as CSRs, others do not. So never combine the two without verification. This is very important again. Forex differences determine whether the gain or loss relates to operating activities, if it relates to trading operations. Classification may differ from the foreign currency borrowings. So what happens is that sometimes company does a trading, and when trading is done in an import and export trading, which has nothing to do with the manufacturing operations, but then there is a forex element involved. That has to be, might be coming under the others. Now here the professional judgment becomes important. So for every item called others, we ask why is this there? Why you have put it into others at all? Because our fundamental principle of cost accounting is to identify the cost as near thereto as possible to the products. Now, when you have an others, which is not allocated to the product, we have to get into the detail. That's why we are getting into the detail. If we could have found and allocated to a particular product or a plant, that product cost would have gone up or come down accordingly. For example, syllabus management includes gain on sale of land. We are seeing a lot of management nowadays is disposing of extra real estate. So they are showing gain on sale of land under others. Would you accept it? No, because this does not represent operational value distribution. It is a capital in nature. So can every expenditure, now let me ask you the one question. Can every expenditure expense be reported under others? Can you please answer this, please? Can every extraordinary expense be reported under others? Can we have all extraordinary expenses coming under others? No, that's right. Only after evaluating its nature. Material exceptional items should generally remain separately identifiable. Now, let us move to the most important practical side. Okay. Now, in this particular thing. Now, friends, we have already spent nearly an hour into this. And now I'm shifting it to the my D4 slide. And I'll just take a minute break to go to the D3 to D4. And then just bear it with for a minute. It's more for a technology facilitation and not for any other reason. Yeah. Okay. Just a minute, sir. Yeah. All right, we are back. Thank you very much. So now, question is that whenever you encounter an unfamiliar expense, ask yourself three questions. Question one is that does this expense arise because we manufactured a product? Very simple. Is it a part of a manufacturing operation? No. Then proceed to the second question. Is it an accounting adjustment? Yes. Exclude it. Then would this expense exist even if production had stopped? If yes, it is unlikely to represent manufacturing cost. Simple. So now before signing Annexure D3, what are we verifying? Every item under others, nature of expense, supporting ledger, cost records, previous year classification, materiality, and consistency. Okay, I'm repeating. Before signing Annexure D3, we'll verify every item under the others, nature of expense, supporting ledger, cost records, previous year classification, materiality, and consistency. One more question to all of you. Why CSR excluded even though it is mandatory under the Companies Act? Can anybody answer this very, very tricky question? I mean, we are excluding CSR, then why it is excluded even if it is mandatory? The Companies Act has made mandatory percentage of profit for a company crossing certain threshold of profit and turnover. And if it is a part of the MCA guidelines, yes, Amit, because it is not part of the manufacturing operation. Very correct. CSR represents the application of, correct, it's not part of any product. Yes, Rajiv, correct. So it represents the application of earnings after the value has already been created. So you see, you look at the regulations of MCA for CSR. It should be a percentage of the net profit. Net profit has to happen before you do the CSR. So that is why so somebody is answering that CSR beneficiaries are not stakeholders. That's not right. Everybody who takes the money out of the company is a stakeholder, including the government. But why we are excluding it? Because it is after the value has been created. That's the simple answer to this. Now we have done huge amount of discussion on that. But before I move to the slide D4, I would like to emphasize one important principle. A cost auditor's responsibility is not merely to copy figures from the financial statements. Our responsibility is to interpret these figures, classify them correctly, and ensure that the cost audit report faithfully reflects the economics of the business. And then if you further expand it, it represents the economics of the country as a whole. So the entire manufacturing activity. So D3 is one of the most important statement. We conclude, ladies and gentlemen, remember that you can give lectures on value addition and D3 to your client, that what has happened to his company on each and every figure. You don't have to just copy and paste it and then forget about it. I hope this has been little useful as far as D3 is concerned. Now, I am again putting on a screen D3 nutshell. Probably quickly you can take a screenshot of this. What we have defined as a value addition. You define the value addition. Then how did we define the distribution of earnings? And then earnings available for distribution should tally with total distribution, fundamental principle. And every line must trace back to some document. Where do you pick up the figure from? You have an authority to ask this question to your client, that where did you get this figure from? And you have to vouch it. Okay. And so this is the hallmark of professional excellence. The D3, most important statement. Now we go to a final last question answer before we move to D4. Can D3 be prepared only from financial statements? Can somebody answer this question? Can we prepare D3 only from financial statements? I give you P&L account. Will you make it? Can you prepare? A lot of no answer. All right, gentlemen, you cannot prepare from financial statements alone. No, dear, you cannot prepare because it requires integration of cost records, financial statements, inventory records, production data, GST records, and supporting schedules. Only then can the cost auditor certify the statement with confidence. Okay. Now, ladies and gentlemen, we have completed the Annexure D3 in great details. We will now shift our attention to Annexure D4, where the focus moves from the value creation to financial strength, capital efficiency, and ratio analysis. This section helps us connect cost information with the broader financial health of the organization. So part D4, headline on the screen, you can see financial position and ratio analysis, placing the product or service cost performance in the context of the company's overall financial strength. So having completed Annexure D3, we now move to Annexure D4, which now will focus suddenly from wealth creation to the financial performance and efficiency. Many cost auditors perceive this section as a simple exercise again in calculating ratios. I respectfully disagree again here. In my view, Annexure D4 is one of the most analytical parts of the cost audit report. As a matter of fact, in my opinion, all the annexures of cost audit report are analytical. And I'll be proving in every webinar that how each annexure can become your consulting prospect or advisory or whatever. Annexure D4 is one of the most analytical parts because it requires us to interpret numbers rather than merely compute them. Again, let me ask you a simple question. Imagine two companies report the same profit. Now, please note that we are into D4, okay? Now, suppose two companies report the same profit before tax of 100 crores. Can we conclude that both the companies have performed quite equally well? Certainly not. Suppose company has A has capital employed 500 crores, company B has capital employed 1000 crores. Both have earned the same profit, but company has generated the profit using only half of the capital. And company A has definitely utilized its resources more efficiently. So this is exactly why this D4 exists. The reason for the existence of D4 is this example. Think of these annexures as complementary, D3 and D4. They are two sides of the same coin. Annexure D3 answers how much economic value has the company created. Annexure D4 answers how efficiently were the company's financial resources deployed to create that value which we had found in Annexure D3. So this is how they are complementary. One is measuring operational contribution, D3. The other measures financial efficiency, which is D4. Neither is complete without the other. I shouldn't say they are husband-wife, but that's a very bad example or analogy. But there are two sides of the same coin is a better. Now, why does the government require D4? Again, why am I raising this question of government? Because our annexures are prescribed annexures. This is not management annexures. And we all stick to this annexures. So why MCA cost audit branch requires this D4? The government, regulators, lenders, managements, investors are all interested in understanding whether the resources invested in the business are generating appropriate returns. Because you've invested, government has invested, banks have invested, investors have invested. So a company may have increasing sales, but if capital employed is increasing at a much faster rate, then the business may actually be becoming less efficient. Similarly, a company may report healthy profits while facing liquidity issue due to poor working capital management. D4 highlights this aspect. The one which I said earlier, that company might increasing sales, but capital also increase. This is typical example happening in all startups. Okay, so you find the gross market value, GMV, and everything increasing very, very highly. At the same time, they keep on putting the capital also. The private equity keeps on coming into the startup. Though there are losses, you cannot say that every startup is an efficient one. What is the auditor's role here? As cost auditors, our responsibility extends beyond calculation. We must ask, are the figures correctly derived? Are the ratios meaningful? Have consistent accounting policies have been followed? Do unusual movements require explanation? Does the financial position support the operational performance reported in D3? Just imagine if every starter has a D3 and D4. It will be a different picture to the investors. Real life example. I once reviewed a cost audit where the debt equity ratio had improved significantly compared to the previous year. Initially, this appeared very positive because better debt equity ratio shows a better financial management. However, upon investigation, we found that the improvement was not due to repayment of debt, but because the company had issued additional equity. So your debt equity improves because you have increased the equity. So your denominator is increased. Your numerator has not come down, and that's where the interpretation can go wrong. This illustrates why interpretation is an important as computation, and this is what a cost auditor should do. Key message which I would like to drive here is that do not treat ratios as isolated numbers. Every ratio tells a story. A good cost auditor reads that story and explains it. Let me ask you a question here. Can a company have excellent profitability but poor liquidity? Can somebody say yes or not? Company have excellent profitability. Profitability is great, but it doesn't have money. It's a poor liquidity. Is it the possible scenario? Yes, Mr. Vinu, thanks. Yeah. Yes. Wonderful. Company can have an excellent profitability but poor liquidity. Yes, because profitability. Yes, thanks. A lot of answers. Thank you, Shaunak. So, profitability and liquidity measure different aspects. A company may earn substantial profits. Yes, Sanjay Kumar, you said no, but let me answer, explain you. Yes, profitability and liquidity measure different aspects. A company may earn substantial profits, but still struggle to meet short-term obligations due to slow collections, excessive inventory, or inadequate cash management. So this is, if they have not controlled their debtors, they keep on doing the sales, but no money comes back. So what is the use of invoicing and showing in the sales value, but if you are not collecting your debtors only? And then can you answer this question? How is it D4 is linked to D3? Can anybody say how? Yeah, gentlemen, we are moving a little fast. We are going to the next question. You can now refrain from answering the previous questions. So now my next question is, why is D4 linked to D3? Anybody can say why is D4 linked to D3? I think our group has now become very active. So why D4 is linked to D3? Many ratios are coming from this. Okay, value added ratio, turnover ratio. Okay. So see, the reason why, how is it linked to D3 is that D3 measures value creation, while D4 evaluates how efficiently the financial resources of the company were used to generate that value. Okay, I'm repeating. D3 measures value creation, while D4 evaluates how efficiently the financial resources have used to generate that particular value which you're showing in D3. So together they provide a complete performance perspective. Now with this conceptual understanding, so my idea was that I explained D4, every part of it, the justify its existence in this, and now let us examine the financial position items that form the foundation of Annexure D4. I have put it on the screen. Now again, what is a D4 all about? Every ratio in now D4 begins with the reliable financial data. Therefore, before calculating any ratio, we must ensure that the underlying figures are correct. We have picked up rightly from the financial statements. D4 draws its data primarily from audited balance sheet and P&L account. However, the cost auditor should not simply copy these figures. Each amount must be examined for relevance. For example, when determining net worth, see the net worth appears as one of the item in the D4. By determining net worth, verify that only the appropriate components such as share capital and reserves are included. Similarly, when calculating capital employed, ensure that the definition used is consistent with the reporting requirements. The objective is not only to calculate, but also to understand these things. Has net worth increased? Why? Has working capital improved? Has debt reduced? Has investment in fixed assets increased? are these changes reflected in the operational performance? So look at it. Your D4 now suddenly gives you uh, wonderful insights into the company. Why the net worth increased, why the working capital improved, debt reduced or increased. And if you have done investment in fixed assets more, that means you have done a capex. And whether it is reflected in the operational performance, so whether the capex has resulted in increased sales or not, all these things will come out of the D4. So prepare a reconciliation sheet linking every D4 figure to the corresponding note in the financial statements. This simplifies review and strengthens audit documentation. You will find that every figure in the D4 you can find out in the notes in the financial statement. One more question. Why should the cost auditor analyze Y-on-Y, year-on-year movements? Can anybody answer why should the cost auditor analyze year-on-year movements, which I mentioned just now? That by going to D4, I can see net worth increase or decrease, capex increase or decrease, debt increase or decrease. Why should the cost auditor analyze this? Why can just not report it? Anybody would like to? Of course, I'm not asking the basic question, is everybody analyzing? I'm assuming everybody's analyzing. I'm asking, why should you analyze? Any answer? Why cost auditor should analyze year-on-year movements in the D4 items? Correct. Right, Dhrumin? For suggestions, right? Exactly. For stakeholders, correct. Very true. So the reason I would like to can summarize the comments which is coming here is the real condition of the company, Chetan. Yes. So because significant changes may indicate changes in business strategy. Anything, the increase in the fixed asset shows that business strategy, you have gone into capex, you're going for expansion. The significant reduction in the debt means your finance management is improved. It includes changes in the financing, operational efficiency, accounting treatment. Such movements often warrant further investigation or further information. I'm not saying everything has to be investigated, but it gives you a great information what company did during the last year. Now let us examine the major financial position items and understand where each figure originates. Now I am coming to the our basic how do we prepare? How do we analyze this audit this part D4? Remember, we are auditing this part D4. So for auditing, what is required? I just don't have to look at the figures, look at the total and say it is okay. No, each and every figure which is mentioned in the D4, right from starting share capital to all the items which I've shown on the screen right now, should be supported by the independent document. Let's start with this share capital. Where will you these things? You verify this amount with the audited balance sheet and ensure consistency with the statutory filings. In the MCA records and everywhere you'll find what is the share capital. Share capital is a fundamental document. If you find any change from the previous year to current year, whether it was a fresh issue of the capital, any reduction of the capital, all these things will come out here. Reserves and surplus. Review the statement of changes in equity and supporting notes. Understand whether movements are due to return. I see reserves and surplus sometimes can have it even includes sometimes the capital reserve, very revaluation, and all kinds of things come under reserves and surplus, and the entire figure belongs to the shareholders. So in a standalone balance sheet, other equity, you can analyze yourself and do that. Long-term borrowings, again, verify launch schedules, repayment terms, and classification. Sometimes cost auditor have that perception or a wrong impression in their mind that they cannot verify these documents. They can. Cost auditor under Section 148 of the Companies Act, where he is appointed, he has an access to all these documents, source document of the data which he is providing. So you can verify the launch schedules, repayment terms, and classification between current and non-current liabilities. Gross and next fixed assets, again, reconcile the figure with the fixed asset register and depreciation schedules, ensure that additions, disposals, and impairment adjustments have been correctly reflected. Net current assets, um, I don't have to tell you, net current is always current assets minus current liabilities. And you can review aging schedules for receivables and inventory as well. Capital employed, one of the most commonly miscalculated figures. Ensure that the formula prescribed by reporting requirements is applied consistently. So audit checklist in this case is now trace each amount to the balance sheet, review supporting schedules, recalculate derived figures independently, compare with the previous year, and investigate material changes. In any of the things, if you find there's a material change in any of the figure, right up to these, so you can ask for the reasons of the change to be the CFO of the company. Now, let me give you an example. Suppose net current assets have increased substantially. This could indicate improved liquidity, one way, because your current assets is more than the current liability. Or it could simply mean that the inventory is accumulated. So what is net current assets? It's a book debts inventory. Similarly, if your book debts have gone up, your net current assets also will be higher than the, so net current assets will be much positive, because what you have done is that you have dumped everything into the debts and the inventory, and you are showing you have great current assets. But then if you go back to the inventory turnover ratio and those ratios, you'll find that actually you are inefficient in holding such a large net current assets. So having established the financial position, we can now evaluate performance through the ratio analysis. So again, if you can go back to the previous slide, Annex D4, we have now gone up to, we have calculated, if you see the first part up to item number 7, we have calculated and collected from the source document where this document is coming from. Now we are also getting the value added, and now we are getting into the profitability ratios. These ratios are one of the most wonderful thing to happen to a cost auditor, to talk about and to flaunt it and to discuss in a variety of ways with the management. Let's start with, so I put on the screen again. First of all, how will you extract this each figure? Then we will interpret these ratios, of course. So profitability ratios is profit before tax upon capital employed. So what does it do? It effectively measures the company uses the capital invested in the business. A rising trend generally indicates improved efficiency. So profit upon capital is like a return on investments. So if higher the ratio, it's a no-brainer. Similarly, you have PBT to net worth. Now you see these numbers are already there in the same annexure above. You are just picking up that number, and there should not be any error in picking up those numbers so that the ratios are correct. PBT to net worth reflects the return generated for shareholders. If somebody is asking at this moment, is there any requirement of HSN code? Please forget HSN codes in this statement. This is the statement for the company as a whole. It is nothing to do with the HSN code right now. This is not a product-wise B2 statement. Now that ratio, PBT to net worth ke baad we have PBT to value added. This ratio links operational value creation with profitability. So it helps assess how effectively the company converts value addition into the profits. So, earlier I asked the question whether value addition means there is a profit or loss. But if you see PBT to value added, it will give you exactly that how much of that value addition was turned into the profits as well. Then PBT to net revenue, this is a profitability margin again. Significant fluctuations should be analyzed in conjunction with changes in cost structure, pricing and market conditions. See, the PBT to net revenue, or like the profit upon sales ratio, is the most fundamental ratio with which a businessman starts his business. If he makes 100 rupees of how much, if he is making 8% profit, 10% profit, 20% profit, this is how actually he would have set up his business initially. So it's a very fundamental ratio. Debt equity ratio, of course, a lower ratio generally indicates. Now see, each one of the ratio, this debt equity ratio itself can take half an hour of webinar, because you might say a lower ratio generally indicates lower financial risk. An excessively low ratio may also suggest that underutilization. You are not, I mean, you have a large equity, you use a very, very minimal amount of a debt. So there is no financial leverage you have taken. Interpretation depends on the industry and business models. So for example, infrastructure industry, it requires a large debt. The debt equity ratio 1:2 standard doesn't apply to the infrastructure company. Why it doesn't apply? Because the bridges, the roads, the infrastructure which you're going to make will require much, much larger amount than the capital which a promoter can bring or shareholders can bring. For example, one large road infrastructure can take 5,000 crores. Now, nobody will have a capital of 5,000 crores. So you will find that debt equity ratio of all infrastructure companies are highly leveraged. Or there is always a debate about bringing a long-term private equity funds for the infrastructure companies of 15 years, 20 years. Because a 5 years private equity fund or 8 years private equity fund will not be sufficient for this. So that's why I said that debt equity ratio is something which cannot be standard. We cannot say that this is a sacrosanct ratio. That is. We are coming to the definitions soon. Somebody asked that what does the debt include? Current ratio, this means short-term solvency. It ratio below acceptable levels may indicate liquidity concerns if the profitability is satisfactory. Working capital ratios, inventory related ratios help assess inventory management. You know, the working capital meaning the how many times inventory turnover. So, if you're having a 100 crores of the revenue, and if your inventory is say 20 crores, then you are 5 times you are doing it. Okay, that's how the inventory gets turned over to convert into a sales. But if you have 100 crores of sales and 100 crores of inventory, then you are in trouble. So your inventory has to be turned over as many times as possible. It shows that there is an efficiency in the inventory holding. It same goes true with the debt also. So debt and inventory debtors should not be it should be of 2 months or 3 months of your sales. It cannot be 6 months of your sales. Then you have to fund it. Where will you get the money to make another? So these are all very simple fundamental thing, but this is available to you as a cost auditor for your client, and you can discuss it with your company. Now, never conclude that a ratio is good or bad solely based on its value. Always ask, how is it changed compared to the previous year? That's very important. How does it compare with the industry norm? I give you an example of infrastructure. And what operational events explain the movement? Interpretation is the hallmark of the professional cost audit. My title is efficient cost audit. Efficient cost audit means you interpret your cost accounting records. Efficiency doesn't mean you prepared cost account or you audited cost accounting records in a record time of 1 week, 15 days, 1 month. That's not efficiency I'm talking about. I'm talking about the good interpretation of the numbers which you are auditing. Now let me ask you a simple question. Is a lower debt equity ratio always preferable? Somebody can ask a yes or no. Is a lower debt equity ratio always preferable? Do we prefer? Are you saying that low debt equity ratio is always good? Yes, Padmaja. No. Yes. Yes, Rajiv. Okay. All right. I wish you had given some attention to what I spoke some time back. Debt ratio is a very subjective ratio. You cannot say that ratio is good or bad. It depends on the industry. It depends on the size of the company and depends upon the market conditions. So a lower debt equity ratio need not be a preferable ratio. Right? Somebody said not always. While lower leverage reduces financial risk, very low borrowing may indicate that the company is not optimally utilizing external finance for growth. Industry context is very, very important. So please don't come to that conclusion. Second question. Little different way. Can a strong current ratio hide operational problems? Is it possible that a strong current ratio, current assets to current liabilities, does it hide operational problems? suppose the current ratio is very strong, do we mean to say that, can we conclude that there are no operational problems? I think what you're saying, no, what you're meant to say is yes, it can hide. What I'm saying is the current ratio can also hide the problems of the company. How? Because high current ratio may result from excessive inventory, or high current ratio can also come from slow moving receivables rather than healthy liquidity. So your current ratio, strong current ratio will give you a feeling that, look, I'm very good and my liabilities are less. But what in effect has happened is inventories are very high and your receivables, you are not recovering well. So ladies and gentlemen, we are, before we conclude today's technical discussion, let us pause and reflect on the broader significance of Annex 24. See, the entire seminar is on understanding the management accounting part of the cost accounting records. So as cost auditors, we are often tempted to view D4 as a collection of financial ratios. However, that should be a very narrow perspective. D4 is in fact financial interpretation of the operational story, which is represented in D3. Okay. That's why I've taken D3, D4 together. If D3 tells us how efficiently the company created value, D4 tells us how effectively the company's financial resources were employed to support that value creation. Throughout my professional journey, I have observed that the difference between a competent cost auditor and an outstanding cost auditor lies not in the ability to calculate ratios, but in the ability to interpret them. The cost accounting records are prepared by the company, so you have no contribution there. Annexes are kept ready and given to you for audit. Now, where you are different from another cost accountant is your ability to calculate ratios is very mechanical part of it. Interpretation is the main important thing. So two auditors may compute the same debt equity ratio. However, one cost auditor merely reports the figure, while the other auditor asks, okay, why has it changed? What business event has caused the change? Does the change align with the management strategy, or is it happened by fluke? Or does it affect financial stability? This analytical mindset adds immense value to the cost audit. For example, suppose ratio improves from 1.5 to 2.5. Current ratio, I mean to say. Current ratio is current assets minus current assets to current liabilities. So suppose current ratio is 1.5, is 150 to 100. Suppose it's gone to 250 to 100. It's 2.5 to 1. At first glance, this appears very positive. I'm sorry. But before concluding that liquidity has improved, let us ask this question. Has inventory increased significantly? Are the receivables overdue? Has cash actually increased? Have current liabilities reduced? Only after understanding the composition should we interpret and comment on the ratio. Now, I would like to connect D3 and D4 before we conclude. Consider the relationship between these two annexes. D3 demonstrates value creation. D4 evaluates financial efficiency. Together, they present a comprehensive picture of the enterprise operational and financial performance. Neither annexure should be reviewed in isolation. Don't take D4 separately and comment. You D3, D4, analyze fully yourself together, and then you can interpret this. One area often overlooked in documentation of this D3 and D4 is always maintain detailed working papers showing source of each figure. When your audit ends, it should be combined with these working papers. Source of each figure, method of computation, cross-reference to financial statements, analytical observation, explanations obtained from management, and supporting evidence for significant movements, which we discussed at length. Strong documentation is the foundation of a quality cost audit. Please remember that, because without documentation, you have given an opinion which is not substantiated by the written evidence. A cost audit report is not merely a statutory filing. It's not like GST filing, for example. It's a professional opinion. Every member certified by the cost auditor, every number certified by the cost auditor reflects professional judgment. That responsibility demands not only due diligence, but also skepticism and also through verification. My almost final questions for the today is, should the cost auditor report unusual ratio movements even if calculations are correct? Absolutely. The auditor's role extends beyond arithmetic. So even if you find, yes, you should always, as members agree, where significant changes exist, appropriate explanation should be documented and discussed with the management. Secondly, if the ratios are consistent with the previous year, can we skip detailed analysis? If you find this ratio same as your last year, should we skip the detailed analysis? Anybody? Perfectly correct. No. Consistency does not eliminate the need for verification. Every year's figures must be independently reviewed and supported. I'll be mentioning more about it when we discuss B2. That just because the cost has remained same year after year, there could be the components of the cost would have changed. So consistency itself does not eliminate the need for verification. Every year's figures must be independently reviewed. Now, having understood the technical aspects now of D3 and D4, let us now conclude the webinar by revisiting the key messages that every practicing cost accountant or even a cost accountant who works in the industry should remember. I would like to now give you a practical example of annexure D3, D4. As I mentioned in the beginning of my seminar, we will conclude with the real life example. I put the ABC Corporation Solutions statement of P&L account. I put it on your screen to give you the practical insight based on the theoretical knowledge given. As you all can look at the screen, this is a dummy statement of P&L account. Based on these and notes to accounts, which is mentioned in the next slide, we will generate part D3. So now we are into, we have understood, we understood the philosophy. We went to the individual annexures to just give a full value to everybody who attended this. Now we will go into the actual preparation of D3, D4 with the actual P&L account. So the P&L account was there on the screen. Now you can see that there are the, we also picked up the relevant notes to the accounts as well, which are required to extract details. Now, this is the value addition, revenues, how it has been calculated. Yeah. Can you see the screen? Is all fully available, and we have reproduced the numbers as well. In this particular company, we have given you the amount rupees in lakhs revenue. Right. So now let's see how do we do this. Revenue from operations. This we pick up from the notes to the accounts, which is the number which is given on the slide. Then I'll be adding the export incentives. Again, notes to the accounts will have the exports incentives. Then I'll do adjustment in the stocks, changes in the inventory, which will come from P&L account. Then cost of materials consumed, again, I'll take it from P&L account. Consumption of stores and spares, other expenses, notes to the accounts. Utilities, again, in the notes to the accounts, in other expenses, I'll find. Others is any which we discussed at length also is coming from notes to the accounts. So I get a total cost of bought out inputs and I come to value addition. This is a derived figure from revenue minus total cost of bought out inputs, and we arrived at a value addition figure. And then I income from any other sources. Again, I pick it from the P&L account. Exceptional items, if there is any, you have to include here, you have to add it back. And then other comprehensive income, again, in this particular case, which I picked up from the real life example, there was a minus figure, so I picked it up. Earnings available for distribution is this. After value addition, I added these incomes. Now this is an earning available to me. And then employees' salaries and wages, which I picked up from P&L account, employee benefit expenses, which is 93 crores. Don't go into the figures. We are just mentioning how we picked it up from each channel. Shareholders is dividend, again from notes to the accounts. So what I'm showing you here is that the sourcing of the document from where it is. So if tomorrow, if MCA cost audit branch asks you to give you the supporting papers for your cost audit, which it does frequently, I have myself been given the notice to provide the working papers which I had provided. Government taxes, others, again, notes to the accounts, non-cost item, and you arrive at a total distribution of earnings. Now we'll be preparing part D4, and the required data for the same is the standalone balance sheet and notes to accounts. We have created again a dummy data, as you can see on the screen. Note the accounts again required for preparing this. Share capital, the balance sheet, equity share capital, you again take it from the balance sheet itself. Reserves and surplus, again, other equity will show this big number. Long-term borrowing, balance sheet will show net current financial liabilities. That's the figure which you pick up. And the fixed assets, gross assets, we will take it from notes to accounts. Net assets, again, notes to accounts. Your depreciation schedule will give you all this information. Current assets, again, balance sheet. We will be sharing this Excel template. Yes, gentlemen. Somebody's written asking for Excel template. Definitely we'll do that. Current liabilities, total current liabilities, again, you picked up from the balance sheet. Net current assets is current assets minus current liabilities. I've given the figure doing minus itself and arriving at a number. Capital employed, net fixed assets plus current assets plus non-current investment is equal to capital employed. Financial performance, then of course, there is a net worth of share capital plus reserves and surplus, which you can do by picking up the figure which is mentioned on the top, and you can simply pick that number. Financial performance, again, value added is coming from D3, which you have already calculated. Then net revenue from operations, P&L account. Then PBT, yeah. PBT to capital employed, the various ratios have been calculated now. PBT to net worth, value added. Then if you go down, it's a debt equity ratio, which is there. Working capital ratios have been calculated, raw material to stores consumption. So as we approach, so this is very simple, but I thought for the very, very fresh CMAs, this could be probably useful. So as we approach not only the time, but also approach the conclusion of today's webinar, I would like to leave you with a few practical principles that I personally found invaluable throughout my career in cost audit practice and consulting practice. Understand before you prepare. Never begin filling annexes without first understanding the objective, which I discussed in detail. If the purpose is clear, your preparation becomes very logical. Every figure must be traceable. A key takeaways I'm putting on the screen. You can take a screenshot of that again. You ask yourself this question: can I demonstrate the source of this figure if someone reviews my audit file 2 years from now? If the answer is no, the figure should not be reported until adequate evidence is obtained. Classification matters more than calculation. Most audit errors are not mathematical. They arise because operating and non-operating items are incorrectly classified. Well-prepared working papers, again, demonstrate the diligence exercise during the audit. They also facilitate peer review, quality review, and future reference. And of course, the ratios tell a story. Do not stop after calculating a ratio. Interpret this. Please interpret this. This is my earnest appeal to every cost accountant, whether in industry or these things, that suppose if you are in industry and your cost auditor has given you these numbers, please discuss at length. And if you are practicing cost accountant, please interpret these numbers and put up in a kind of a management note and then how did you interpret? Ask questions, discuss with management, document your conclusions. Professional skepticism. I mean, we are not saying that we should doubt every number, but skepticism means that always maintain an independent mindset. If a figure appears unusual, investigate this. Do not accept explanations without supporting evidence. Somebody can just not explain away, oh, boss, this is how my industry works. We'll require the evidence all the time. And cost audit, basically, it's a continuously learning. It's constantly evolving. Regulatory requirements, accounting standards, taxation provisions, industry practices continue to change. Remain updated through institute publications, professional seminars, and continuing education. Our institute is doing a wonderful job there. It's full of knowledge bank, full of information, and lots of webinars and seminars keep on happening to do updating of the skill of the cost accountants. Please use this fully. And one more important point is remember that every cost audit report carries your professional signature. That signature represents competence, integrity, and last but not the least, independence. Protect all these three, your competence, integrity, and independence. That's the fundamental requirement of any auditor. Now, my last question. If you were to implement only one improvement in your next cost audit assignment based on today's webinar, what it will be? Please, I'll wait for 2-3 minutes for the response. If you were to implement only one improvement in your next cost audit or ongoing cost audit assignment, currently we are in the audit peak period, what it be that you would like to pick up out of this webinar? I would like to answer, please. I'm thanks to all your compliments, but please answer this question. Which is the one improvement in your next audit assignment based on today's webinar you'll be doing? What is the one improvement? Tell me one improvement in your next cost audit assignment. Is everybody thinking so much? Right? More detailed analysis of financial ratios. Yes. Yeah, proper linkages. Interpretation of ratios. Yes. Yes. Yeah. 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 Good answers are coming out. This is interesting. Yes, maximum importance to D3, D4. Very true. So if I summarize, improving documentation, strengthening analytical review, and maintaining professional skepticism are the most valuable improvements. Is that right? This is what we should aim at, improving documentation and dialogue with the management. This is most important. Now, I don't know whether, we still have a 10 minutes time. So, which I've already covered these questions earlier, but we are almost now reached the conclusion of today's webinar. Honestly, we have covered almost each and every point when I'm looking at my notes. So I think I can only conclude that I sincerely thank each one of you for your active participation and the keen interest you have shown throughout the session. Today, we have not merely discussed how to complete this D3, D4, but we have also examined the principles behind these annexures, the audit procedures that support them, and the professional judgment required while certifying them. So as practicing cost accountants, we play a vital role in strengthening corporate governance, improving transparency, and implementing, enhancing a confidence. So every cost audit assignment provides an opportunity not only to ensure statutory work, but also to add value. I encourage all of you to revisit today's discussion while preparing your next cost audit report. And you're free to write an email to me anytime. I put the email address and the website on the screen. And I now final closing remarks before we conclude. A final thought: cost audit is not merely an exercise in compliance. It is an exercise in understanding the business, validating its cost information, and presenting an independent professional opinion that stakeholders can rely upon with confidence. I wish you all of you a continued success in your professional journey. Thank you once again, and I look forward to interacting with you in the future sessions of the guide for efficient cost audit, which is happening in the next coming 2 Thursdays. Over to WRC, madam, please.
Yes, sir. Thank you, sir. We will open for 5 minutes for question answer session, sir.
Sorry? Hello?
Hello.
Yes.
Sir, we will open for the question answer session, sir, for 5 more minutes. Sir. If anybody has any
I'm fine. I'm fine with it. Yeah. Yeah.
If
Take it from
anybody
your
has
computer.
any questions.
Yeah, I'm open to questions, madam. Yeah.
Yes, sir. In the chat box, there is one question, sir, from Sakshi Doshi.
Let me. Can you repeat the question, please? Sorry, I had power off and I shifting to another computer.
Okay, sir. Sir, question is if material consumed included packing material stock in financials, it should be excluded or included in value addition.
No. See, let me go back to the packing material is a part of the raw material consumed. For that purpose, you have to go to the cost statement, madam. B2. You go to B2. You would have included the packaging material, raw material, etc. Right? So this becomes part of the value addition. Yes.
Okay, sir. Sir, one more question is there from Dhrumin, sir. If any new industry audit comes of petroleum or electricity, but have served only manufacturing or construction client.
Sorry, can you repeat the question, please?
Yes, sir. The question is, if any new industry audit comes like of petroleum or electricity, but have served only manufacturing or construction client.
Yes.
Sir, my question was like how to deal with new assignment, like totally different industry. So how to like change the methodology or approach, because industry to industry it will get differ.
No, industry to industry, cost accounting records will not change, no?
No, record will not change, but methodology or approach, because some will have no closing stock. Like for electricity, there will not be any closing stock or some sort of thing. So wastage and all that.
No, so then your revenue becomes your revenue. There is no stock adjustment at all. This is perfectly fine. I think you rightly gave the example of electricity, wind energy. There is no opening closing stocks. So you assume that there is an opening stock, but it is a zero. There is an opening stock, but it is a closing stock, which is a zero. So basically your sales revenue itself becomes a total figure. Your stock adjustments become zero in that case.
Okay, sir. Okay. Okay.
Yeah.
Yes, sir. There is one more question from Chetan Gandhi, sir. There is a debt equity ratio we are calculating. Then we include only long-term debts, but debt is silent whether long-term or short-term will be included or not, and why?
Generally it is always a long-term equity and debt. I had seen this question even while when doing I wanted to answer that time only. Yes, it is a long-term debt equity.
Sir, one question, please.
Yeah, please.
In your example, you gave an example of minus comprehensive income, OCI. OCI was minus. Normally, we deal with positive OCI. So, can you just explain in a few words that how the OCI was negative?
Let me go to that particular state. I think what you're saying, the statement, I was just looking at it because the real example which we picked up in a negative comprehensive income. Please ignore that part. I have mentioned also while present that why it is negative, because it was picked up as the live example was having a negative one.
Okay.
Any other questions?
The company reappointed is closed manufacturing remains in trading of the product. So this is, madam, the last question, Mr. Ramkrishnan, is more related to the rules. See, the rule says that once your audit has started, it remains, applicable. Then if it goes back to the trading, then you have to write to MCA to get yourself exempted the cost of it. Mr. Ketki Vesaria, stores and spares cannot be included in RM. Stores and spares cannot be, where is it? Have we included in the RM somewhere? In the sheet? Stores and spares is separate. It is never in the RM. You are right. Now, Mr. Dasari has already answered to Mr. Ketki. You are right. It cannot be included in RM.
Sir, I think there is no other questions from the members.
Wonderful.
Then we will conclude
All
the
right.
session, sir.
We conclude the session. Yes, please. And we look forward to see you people all on next Thursday for more important pro forma. And be ready with your questions since we are all performing this pro forma very regularly. Yeah, over to Pujanka, please.
Yes, sir. On behalf of the Professional Development Committee of the Western India Regional Council of the Institute of Cost Accountants of India, I express the heartiest gratitude to Dushyant Dave sir for the wonderful and interactive sessions, and thanks all the participants for participating in the webinar series. Our next session is on next Thursday. I request all the participants to kindly join. Now we will officially conclude these sessions. Thank you very much.
Thank you, everyone.
Thank you, sir.
Thank you,
Thank
sir.
you. It was a pleasure to interact with our fraternity. All the best to everybody. Yeah. Thank you.
Thank you.